gentlemen, now we know that this is the decade for India. The theme for this event has also been rightly set accordingly. With the number of investors growing in India, the appetite for risk amongst investors is also increasing. And with that, the fine line between calculated risk and the peril of greed becomes increasingly crucial to discern. The next session has been set up to empower investors with the wisdom to navigate this tightrope, to help investors explore the essential tools and strategies for making informed decisions that optimize the balance between risk and reward. Having put that out loud, let me welcome our esteemed panel that will discuss as more investors embrace risk, how to make informed decisions and avoid the greed trap. We have with us Mr. Nimesh Mehta, who currently heads the business development, products, and sales at ASK Investment Managers. Mr. Mehta has more than 21 years of experience in industries ranging from NBFC, equities, asset management, and financial services. He's an author of an international bestseller book on Amazon titled Sales Booster. His business acumen has helped ASK Investment Managers become one of the largest PMS managers in India. Mr. Mehta is a commerce graduate, MBA, and certified financial planner. We have with us Mr. Ananya Kumar, the president and national sales head at 360 One Asset. He is responsible for driving the domestic sales at the company. And Mr. Kumar has more than 2 decades of experience in corporate banking, retail banking, wealth management, and asset management in senior leadership positions and has handled both B2B as well as B2C segments of the business. And this session is going to be moderated by Mr. Rakesh Rathod, who is the lead of advisory business at Small Case. He's a finance professional with 24 years of experience and has been instrumental in setting and scaling up of domestic business for Nuvama Prime Brokerage Services, where he championed the growth PMS AIF industry. Now, Mr. Rathod is a chartered accountant by education. He's also a certified financial planner, postgraduate in investment banking, and a SEBI-registered investment advisor. Mr. Rakesh has worked with leading financial institutions such as Sher Khan, Motilal Oswal, 360 One Asset, Prabhudas Leeladhar, and MCXSX. We are very, very privileged to have our eminent panelists with us. Thank you so much, Mr. Rakesh, for agreeing to moderate this. And now it's over to you.
Great. Thanks, Aishwarya, for setting that great context and just picking up things from where Aishwarya left. So good afternoon, ladies and gentlemen, and thanks once again for being part of this great event, which PMS AIF World has been hosting year after year. And I think in middle of this entire conversations of all these great products and asset classes, I think I'm just trying to be what you can say, right? Mute those things where we have been talking about wealth creations and returns and all that. So in middle of that, I think this is one very, very important thing which one should be mindful about, which is risk. So before starting with my great panel, just setting the context of the PMS AIF industry as well. So we all know PMS AIF industry has come a long way from being a product for few evolved investors, right? To lakhs of HNIs investors who now have access to the best of best money managers on the street. From 5 lakh ticket size to the current 50 lakhs, it has covered some good distance to become an industry of around 800 plus PMSs today we have, right? And 800 plus AIFs with AUM of over 5 lakh crore each. Of course, it has evolved on all fronts, be it regulatory reforms, be it technology advancements, and of course, more on the product as well. And to be fair with the category, with the industry as well, I think PMS and AIF has delivered very, very competitive returns, attracting increasing investor returns. So that is where this whole panel has been set up to bring one more flavor, which is very, very important and which sometimes, or maybe I will say most of the times, get missed in the current times what we are right now experiencing. So due to the kind of liquidity chasing, right, the Indian equity markets right now, how much valuations has changed, we all know, right? So just wanted to understand from that flavor, that is 25, 30p the new normal. So with that as a backdrop, maybe I'll start straight away to the topic and to Nimesh from that angle as well. So Nimesh, thanks a lot for joining in. And my first question goes to you. Are you ready, Nimesh?
Yeah, absolutely.
Perfect. Great. So, Nimesh, we all know, right, while considering the asset classes in investments, right, it is very, very important to understand that personal risk tolerance. But the actual question is, how does one access this risk tolerance in our constantly changing markets? Because risk is a very, very personal thing, but I think somehow we start equating risk to the markets than to the personal self. So if you can just throw some light on that nuance, that would be really great for our audience.
So thanks, Rakesh. Thanks, Aishwarya, Kamal, for setting this up again. I think you answered the question in some manner, and I would believe to that risk is always internal and not external. I think you asked whether the risk tolerance on continuously changing markets. It is never dependent on constantly changing markets, because the rules of asset allocation applied 20 years back, 50 years back, and even now. For example, you know, I've been reading equity markets for about 25 years now. Equities continue to be a volatile asset class then, a decade back, and even now. Maybe the extent of volatility is faster than ever before, but volatility is a part and parcel of this beast of equity investing. And therefore, to me, the basic rule of investing does not change. That is, any investor who, if he needs money before 5 years, should never come to equities. And any amount less than 5 years should ideally come into fixed instruments as per the risk of each instrument there. And if one were to, widen the asset allocation to gold and commodities, I think the nature of the beast there remains similar. It's very cyclical. It is very short-lived. You may get returns in commodities in 3 years, what you may not get in equities in 10 years out there. But if you take a decade, this one, then the risk or the returns are maybe a little bit better than inflation as far as gold and commodities are concerned. So why do I say risk tolerance is more internal? Because each individual age is different. And within, say, I've had an opportunity to meet clients over the last couple of decades, and within the same age, also the financial position is very different. Some may have housing loans, personal loan, car loans, credit card loans. So I think for those set of investors, investment equities for less than 5-7 years is clearly avoided. So therefore, I would end my answer saying that risk continues to be still internal and not dependent on any external circumstances.
That really helps, Nimesh. So I understand as a ASK, you have been at the forefront of creating a lot of path-breaking products. But let me come to Ananya, right? Ananya, where you have been wearing the advisor hat, right? Where you tend to create that layer on the top of a lot of exciting products. So as an advisor, what would be your view with that lens for the clients for the same question just I asked to Nimesh from the risk point of view? Because I think in advisory, the spotlight is more on risk, right? And returns tend to just happen, or maybe the outcome and all that.
Yeah, thanks, Nitish, and thanks, Kamal, for inviting me on the show, and a very good afternoon to everyone. Let me extend my perspective to where Nimesh has left, and rather than being repetitive about it, let me give a little bit of a different color. See, it's very critical in today's time that we need to understand risk, because at the end of the day, there is a strong correlation of a risk and a return. So that's important. You cannot ignore the risk forever. Yes, it's equally important to understand that to paint everyone the same brush, it's not the way to look at, because for every individual, the gravity or the intensity to onboard the risks are very different. And hence, as an advisor, it's very critical that we first understand the profile of a client pretty well. While understanding the profile, there are 3 or 4 answers that we need to find. The answer is the acid test on the liquidity. That's very critical, because the liquidity needs of the clients are very different. Now, when you talk about liquidity, obviously you're talking about assigning the risk to the liquidity, because as you would go longer on your time horizon to let the money invested, your propensity to onboard risk become that much more. Shorter the duration, obviously you will not be able to onboard. And hence, the moment a liquidity call comes, is the call that gets straight away associated with what kind of risk that you would want to associate with. Third thing is, both of them have another strong correlation, which is the correlation to the return expectation. See, my return expectation is just to beat inflation. That why am I chasing an asset class which can give me a high double digit then? It's not my return, that's not my expectation. Or I am an aggressive guy, a new kid on the block, ready to take on board the risk. Why am I asking him to look at a fixed income or something which carries very low risk? Why? Because horizons are higher, the demands are very different, needs are pretty different, and hence my ability to onboard the risks are very high. Now, when we talk about all of this, obviously here comes the, how do we grade them in? It could be, as Nimesh rightly pointed out, it could be at an asset class, wherein you can look at something on a commodity, which could be the gold and so on and so forth. It could be the equity, it could be the non-equity, which could be the fixed income elements and all. But the beauty is, within the equity, again, we can further classify to call it a listed equity and a non-unlisted equity. Within the fixed income, we can further classify as a performing credit and a normal credits. Now, the moment we get into the bucket of a unlisted equity or a performing credit, let's understand the very fact, the very perspective of liquidity comes on the forefront, because these are very illiquid assets. And hence, even if you in your own assessment feels, look, I'm in an equity and hence my risk is to an extent, or I'm in a fixed income and my risks are lower. No, doesn't the case. If you are in a fixed income with a performing credit, then you are actually onboarding a risk which is slightly higher. It may not be the risk on return as much as it is the liquidity risk that you're carrying. So, so when we are advising and when we are going and talking to the people, we need to wear different hats, because I strongly believe that every client have their individual requirements and hence a very personalized response to every client's needs.
Sure, Ananya. I think that was super insightful. So maybe I'll just come to the next question and just setting the context for that as well. So we all pursue for an informed investor, right? And in the era where information is just so overflowing that at times you don't even realize that as an investor, we end up coming with a lot of our own advices to ourselves in our head and all that, and solutions also, and we just need that validation. So I see a lot of investors like coming and just starting out that, okay, कौन से AIF में invest करना है, कौन से crypto में करना है and all that. So with that context, Nimesh, with the rise of this alternative investment options such as cryptos, derivatives, how can investors navigate the complexities and the risk associated with these assets, right? Because again, as I told in the opening remarks as well, the whole conversation is only about returns. How can investors differentiate between genuine opportunities and the risky gambles, and what are the red flags to watch out for? Not necessarily for a particular asset class, but more in general kind of thing on a first principle basis.
Did you ask Ananya or me?
Yeah, Nimesh.
Okay, so I can only share what has worked for me, and I'll cover both. I think it was a long. I think you talked about cryptocurrencies. You talked about how to invest in an asset class, and maybe I missed out something else. So I'll share because it'll help if the personal experience is been spoken. The understanding would be far better, and I'll cover both topics. So after I became a CFP in 2008, I think one of the things which I did the first was to create a financial plan. And I think that was the crux or the most important part of my investment journey, which I can say I was in the markets for long, but maybe from 2009 onwards is when I actually started to understand investing and then start to, really benefit from it. So a couple of factors that work for me, I'm building on to again what Anunya, because the questions are similar. Couple of things that work for me. I think investment goals, time horizon, and return expectations all came in from the financial plan which I made. And let me confess, I did all the mistakes before the 2009 debacle. And I'll talk about two mistakes. I used to invest in all the junk kind of stocks, and I lost a lot of money. So I stopped investing on my own, and I started reading more books. And I remember in one of the book, Buffett said, research before you invest and not after. And I realized I used to always do research after I invested out there. So about good 4-5 years, I spent time in understanding and reading books to understand them. And therefore, about 2013-14 is when I reached a place where I thought I can start investing on my own. And so one of the investment goals came up by the time that two daughters had taken birth. And I said for the higher education, I bought Bajaj Finance in early 2014 at about 300 odd rupees. And with three things which I did. One is the goal is to give when Anika becomes 20, 21 years old. Second, so the longevity, the time horizon was defined there. It's 20 plus years from 2013 to almost 2032 types. And then the return expectations, which I set up from my learning of the past, has been about 13 odd percent compounded. If I get, I should be happy about there. And interestingly, the journey, same time, I joined ASK and I put my own money in the PMS for the second daughter with the same objective, 13% returns and for a tenure of about 15, 20 years. What happened in the case of Bajaj Finance that the price rallied from 300 to 200 rupees in a very short period of time. And I was left in a lurch as to what needs to be done now. I was really nervous because I couldn't believe that 300 rupees, 400 rupees has become 1,200 rupees. And I kept looking out everywhere around. And every investor or every information I tried to capture with brokerage reports and all that, including one of the gentlemen I knew in Bajaj Finance, told me to sell the stock then. And I was almost on the verge of selling that because 3 or 4 times return in a year was an exceptional return to make out there. But I came back and I said, referred the books, referred my goal, and it said that I need to for 20 years. I need to bother about it there, and I actually didn't sell. Unfortunately, the way volatility, which I spoke in the previous slide, previous question I spoke about there, it fell down to almost back to 500, 550 levels. And trust me, I lost sleep to an extent that 2-3 months I didn't sleep. To the right side, I move. I can see Sanjeev Bajaj. To the left side, I can see Rajiv Jain. And I was just praying to there's a temple in Parlais where I live, and I just kept praying to God that just let the price come again, and I will not do this mistake again. But again, I went to reading a little deeper out there, and I said, okay, no worry. I am anyways for a long term learning from the great investors. I stayed invested there, and from that day. It took me about a year to again evolve and be ready with those volatility there. But till today, I haven't been able to. I haven't been able to. I didn't sell. Rather, I topped up there. And what I wanted to achieve, my daughter's goal, has already been achieved earlier. But again, the time horizon, I'm not jumping the guns. I'm actually continuing with the time horizon because I need it later. So I'm keeping patience, and when an opportunity comes across, I did that. Same for in terms of the PMS. I think it's been a journey of ups and downs, but the return of 17% in the PMSs has been very satisfactory. And just add 2 more factors, which will be very helpful. I believe the investor will be there. I think what helped me was the discipline and patience. And this came with right people, working with the right set of people. I needed to have that patience for equity markets to give me the return. I need to have the discipline to stay the course. If I would have had, both things not done, I think I would have ended up being in a far poorer in terms of return wise than what it is today. And I'm glad that I stuck to that. So to me, the financial plan, the investment goals, the time horizon, and again, the return expectation, which Anunya spoke earlier, coupled with discipline and patience would there. Since you added one more thing, I want to, if we can talk about, be very helpful. Since you spoke about the cryptocurrencies, and also, if that okay, I'll just finish the other example. Maybe it'll be very helpful for the people. So I think I would recommend that people to stay away from sophisticated products unless you are very well aware, knowledgeable, and again, it falls into the from the financial plan. And again, if I go back to my example of 2008, not for crypto, but derivatives, I slowly became overconfident from a journey from 2005, 6, 7, made a lot of money and started doing derivative transactions. Inside the derivative, about 6 months I probably earned 6 lakh rupees. And I was like on the top of the world. I thought, I now know how to crack the code as far as derivatives are concerned. And as I said, 6, 7, 8 lakhs I earned. But on one day in 2008, I lost almost 13, 14 lakhs of rupees in just one transaction. And that one transaction made me put money, in those days was difficult, put 6 lakh or 7 lakh of rupees out of my own pocket. I realized that this is something I got into, which I never understood. I was just greedy, wanted to make returns faster. And therefore, when I made that plan, from that day to today, I haven't stepped into derivative transaction, irrespective of the information I had or not. But again, I would say I saved a lot of my money in losing in those derivative transactions. And therefore, when cryptocurrencies came across there, I immediately thought that this is not cup of my tea. Neither do I understand. And wherever people understand, you can do it. But if you don't, then I think I would say these are one of the fastest way to lose your capital. So one would stay away. As it says, mass destruction of wealth is the way from doing the sophisticated assets. Sorry for a long answer. But,
Great. No, I think you were kind enough, Nimesh, to share your personal story, and I think that gives me a lot of cues for my next question to Ananya. And especially, I keep on telling this again and again at the cost of being repetitive, because I think advisor role is super important. I just can't undermine that role. I have been in that space for last couple of years now. So I think it's more about the behavioral aspect than the products and all that, right, Ananya? So what you feel are the implications of the behavioral biases, which Nimesh, of course, briefly touched upon in his personal story. But because you come across so many investors, so many clients in your day-to-day interactions, what have been some of the top of the mind behavioral biases or emotions on investment decisions making, which has worked in favor or against the investors, and how investors can overcome these psychological barriers, according to you?
Okay, thanks for this question. It's a very relevant question. But before that, I just would want to add to one point that Nimesh mentioned about the cryptos. I am a strong believer anything that's not falling in the regulatory framework, refrain from being a part of that asset
agree
class.
completely.
Period. Well, we understand that within the regulatory framework, also the element of risks are so high that we aren't able to contain and control that. Then why to venture into an uncharted territory where the regulators are also not putting their minds? So that's very clear to me. Anything that's not regulated is not even a part of the thought process.
Thanks for adding that on you. Lovely point. Thank you.
Yeah. And getting back to the second part, I think, yes, the beauty is what? The beauty is that when we look at our own assessment of risk, it becomes a variable number. Why it becomes a variable number? Because we start assessing our risk looking at the neighbors. And then what comes up, all the in our world, we start deriving all of this, calling the number of a FOMO, blah blah, and all of that. In one of the recent discussion when I was having in a city with someone, and I said, look, your advisor had done a great job by getting you 15 to 16% compounding. And to me, I think that's a fantastic job in looking at the way he structured the portfolio for you. And the response was, is it, Anune? I said, what do you mean by is it? He said, look, Unitech can give me 20% every day. Now, the beauty is, this is a classic conversation of a bull run, which has got backed by a 3-year of consistent bull phase, where people have started feeling that, look, money making has become very easy. Look, I don't say that one shouldn't get influenced with a herd mentality, because herd approach also helps you at times recognizing certain asset classes, which probably is not in your radar, but does make sense to you. Now, there are 2 ways to do it. One is that you get on your own, doing all those theses, do a lot of reading, figure out what still can make sense in the market time that we are in today, or you can make it life very simple. Go to a good advisor, the guy who is tuned and who is informed person to help you, and then be a part of it. So in a way, that's a very beautiful way of doing it. But please understand the importance that the recognition and an importance of what the risk is for you is very important. On the contrary, the way I would like to call about is, it's a fund manager's job to beat the benchmark. It's not a job of an advisor. He has certain agenda which is given to, because that's the way his KRAs are defined. If you are an advisor, why are you after a benchmark of BSE 200 or a Nifty? My friend, for you, the benchmark is your client's goal. Because if client has signed with you, with a certain objective of saying, look, 20 years down the line, I have one of the goal, which is to meet my daughter's marriage, or to take my son or a daughter for a higher education, or maybe 25 years down the line, I have a retirement plan. Be mindful. The only need of today for which you will not get a loan is the retirement. You don't get loan for retirement planning. You have to plan it now, build a corpus today. Now, if that is the reality of life, then my benchmark is, am I making 12% compounding, which over next 20 years or 25 years is going to lead me to a corpus which is good enough for me to survive for next 25 years. If that is what it is, then your 12% becomes a benchmark for you. And you would need to assess whether over a 3, 5, 7, 10, are you in line in terms of fulfilling your requirement? That becomes a benchmark. And hence, for every advisor, he needs to be mindful that the benchmark is not one, but many. Why? Because every client is a benchmark for him. The moment we take that approach of an advisory, believe you me, all the discussion around a FOMO or onboarding the inordinate risk on the portfolio, or trying to venture into the areas which by normal prudence is not desirable. And hence, as Nimesh quoted in his example, he had those sleepless moments where he kind of either lost the liquidity in inordinate amount, or he got the feeling, look, am I on a track to fulfilling a goal for which I onboarded an asset? I think, to me, summing it up all would mean be with the right advisor, pick the advisor more than anything else. That's the right answer. And for advisors, don't chase the benchmark of a Nifty, BSE 200 or BSE 500. Create a benchmark which is a benchmark for your client, because he is more keen on fulfilling his goals rather than looking at whether markets are making 30% or 40%. That's where I would want to answer.
Yeah. Thanks, Ananya. I think that was a really great insight on the top of what Nimesh just shared. Yeah, Nimesh, sorry, you wanted to...
No. If you allow me to share, because this is one of my favorite subjects. I read more on the behavioral finance, and therefore, if you allow, I'll just
please.
share. So, to me, behavioral finance or behavioral biases is the important part in individual investing. So, investing or personal finance is, to me, less of finance and more of person, which I spoke earlier. Let me touch upon from my from my study and interaction with clients, what are the few of the biases which every one of us has, and we need to overcome that. One of them is loss aversion bias. What is loss aversion bias? It refers to the tendency of the investors to strongly prefer avoid losing or acquiring in. I'll explain. They may hold on to losing position for too long, hoping that the stock will recover instead of cutting their losses. For example, and I keep meeting during PMS's, people show me their demat accounts. Recent times also I've seen people holding Suzlon Energy, JP Associates, Unitex of the world, way back from 2008 period of time. And for 15 years, they've been holding on stock, hoping and believing in that someday they will come out and do that. Not realizing, and at the same time, what has happened is that client would have bought Bajaj Finance, Asian Paint, HDFC Bank, Titan Bank, so on and so forth. But every now and then when it run up, it sold it out there. Yeah. And I think this is the trap which market gives you. One should not have ego in the equity markets. Okay. There are a lot of communities whom I meet, they say they never sell in losses. Now, if you realize that there is a mistake, there's a fundamental wrong in the portfolio, then you must try and this is pure investing I'm talking about there, in that you must cut in terms of your losses immediately. Because, let me put some arithmetic number out there. If your 100 rupees fall down to 50 rupees, from 50 to 100 rupees, it is 100% growth and not 50 rupees growth, which sometimes people don't really understand. And therefore, at that point in time, one must see from a 50 to 100, will a JP associate take me on that day, or maybe a bank or, a Titan or what will take there. And that is where one must understand this, biases which we have in investing. And instead of, holding on to the donkeys and cutting down the horses, one should do the reverse in terms of there. The second thing, which briefly in some manner Anunya spoke about there, it's called the herding bias. What is a herding bias? Refers to investors' tendency to just follow and copy paste what others are doing. Yeah. they are largely influenced by, by what others are doing, forgetting what the investment plan are there. And some of the few very simple examples to all of us, in the last couple of years, small and mid cap have done brilliantly. So people have forgotten what is risk appetite, what is appetite, asset allocation and all, and people have just jumped into as if there is no tomorrow. And that's where the risk comes in there by not looking back. And if you just go back 6 years back, there have been a fall of mid and small in 2017-18 to the extent of 50-60%, and the pain happened. Unfortunately, that's not been realized right now, and therefore, same, the previous question on cryptocurrencies, there was a herd a few years back. People just went as if there is no tomorrow, and people have lost crazy amount of money. For the people I have interacted, I wouldn't say that people have not made money, but for people who have not, they have lost a lot of money. And last, maybe I can stitch the piece together, which is very critical for a recency bias. That is again a very important factor, because what that suggests is investor puts more weight to the recent events and forget what will happen in historical trends and then making decisions. And what has been, and unfortunately, fortunately for us, that we now have close to 14 crore demat accounts out there. A large part of accounts have been opened in the last couple of years' time. But what is the recency bias in the mind of investor? That I can make returns faster. Then, Anunya spoke about professionalism. I can do it myself. There is a belief that I just need to keep adding SIP, which is a fantastic habit. I'm not denying that. But because they haven't seen a difficult or a bear cycle, everybody is in the recency bias and just continuously going in there without, in terms of taking cognizance of the risk which they are taking into the market, having not seen the cycle. So, and I can go on with a couple of biases which I'm looking at time further there. But how do you overcome, which Anunya spoke about, but two things very simple. First, the idea to share was to become aware of the biases. Because once you're aware, you can start practicing or start reflecting day to day to overcome it. Yeah. You then again look back into how have you done in your last transaction, what is the mistake I did that, and you have to keep talking and keep writing it down to overcome this bias. I can't say that I have become master of all of this, but I can say I'm still a student and understanding and getting better at the other biases. And second, I think Anunya said it beautifully. For a lot of people, managing money is difficult to keep emotions in check. And the greed, the fear part, the relationship with money is so attached. So the best way is to hire a wealth manager, a professional manager who can manage your money. I think I would say that's period. You don't need to really do it yourself, because that is where the herd mistake will come in. I made a lot of money in the last 1-2 years. It's always better to find out the best asset manager or a wealth manager and hand over to him. And that's how, in terms of you overcome these biases and be able to create wealth in this so-called $6 trillion is I think the PMS AIF World title, $6 trillion in 6 years. So one can benefit from it. I'll stop here, Rakesh.
Sure. No, so thanks, Nimesh. I think that was just adding one more layer of perspective and the validation of what Ananya just mentioned. So maybe my next question is to Ananya. And I know, Ananya, you have been traveling a lot and you have a lot of years to the ground as well, meeting so many investors. And as Nimesh also mentioned, that at times, a lot of these new investors, right, in the last 3-4 years, there's a huge new breed of investors who have just entered the markets. And maybe it's just a time that they have not seen a cycle yet. But tell me something, Ananya. What are you seeing in terms of investor self-awareness towards the current market environment, right? Is there a genuine increase in tolerance, or are investors simply being pushed towards more volatile assets due to low returns elsewhere, or maybe lack of opportunities elsewhere in the current market environment?
So great question once again. To me, the good thing is the flow of information are so immense that for one to believe that the investors aren't informed, I think that's a great myth that you are in. So first of all, if you're an advisor, don't assume that a guy doesn't know. He certainly knows. What possibly could happen, the lag period could be a little bit. Today, you have given an advice which is not in his interest. He'll get to know maybe another, a span of maybe 2 or 3 quarters. But once he get to know, be prepared to build a strong defense, because then you will have a tough time explaining him. Especially remember, the new investor is a category which can actually get you the bout of gold. And I'll explain you why. See, he has not understood what this investment is all about. You are the one who has migrated or who has made him transit from a, so to say, traditional ways of managing the money like a real assets or deposits. And then you have kind of got him into the capital market, which you also felt that was a great one to do. And you actually make him make the money. You know what you have done? You have not only made him realize what he was missing, but actually he becomes your brand ambassador to 10 of your friends or 10 of his friends and say, look, I was blind to something. He's the man who got me in. He's a fantastic guy. What did you do? You served his need. In the process, you served your own need. If you do the other way, serving your need and the process serve the client's need, get prepared. Sooner or later, he's going to knock your doors to ask why. Now, when you are talking about a new investor, let me tell you, yes, you are right. The awareness or the eagerness, both the ways, among the people is pretty high, pretty high. What potentially is lacking is to know what is the path that they should be taking in terms of moving. Because at the end of the day, please understand the mindsets are different. We aren't moving a small cap guy into a PMS or an AIF. Why? Because he understands the risk. I'm actually moving a conventional guy from a fixed deposit to the world of capital market. And hence the transition needs a lot of hand holding. So I think if we are able to tell the guy, it's 6 or 7 critical things like an investment objectives. What are the objectives of the investment? Do the proper risk disclosures. Make him understand there is a strong regulatory compliances around the product that I am explaining to you. Create right performance expectations and not go and overdo that. Explain the fee structure. Please understand, India still is a country where you may explain a lot about the feature of a Maruti. At the end of that, he's going to ask you, what is the efficiency? That's the reality of the life. Let's understand which country we are in and what mindset of people we are transiting into this. Please make him understand a diversification strategy. Why are you doing what you are doing? There's an element of prudence which is coming on account of diversification. Please maintain the communication channel very effectively and very efficiently, because at the end of the day, engagement defines the deepening. More you are building an engagement, more would you be able to deepen with him. While doing all of it, be very, very mindful of risk assessment. What is the risk that a guy can potentially onboard? And make him relax and make him comfortable to say, look, you have a complete accessibility to me and my supports are extended to you every time. Believe you me, if we follow these 8 or 9 points that I have just said, and you get him what he hasn't seen, he is not only going to be
Have we lost Ananya connection?
Looks like. I was wondering that if I got hanged.
Yeah, Ananya is back. Ananya, yeah, please.
I'm back. So I don't know how did it happen, but so if we are able to do these things, in a smarter way, I can tell you, not only he is going to stay with you for life because he has seen something which he hadn't in his life through any other means, but he is your trusted ambassador to get you as many as you want. So I think this is where I feel it's critical.
Sure. No, I think that's great, Ananya. And I think before I make my concluding remarks, I'll go back to Nimesh for the last question. Nimesh, again, because you have been meeting a lot of investors, large HNIs and all that. So if you can just share your 3 golden rules for making an informed decision in general, and of course, investing in a PMS or AIF in particular in terms of the client's expectations, that how the product gets aligned with the client's expectations or vice versa, so that at least the journey is great and the goals what Ananya just mentioned about are achieved in the desired time frame.
Yeah, so I am looking at time as well, and I think Ananya spoke beautifully. I think since you talk about PMS here, let me just dive into my experience. What I've seen over the last decade, the average age of a PMS investor or AIF investor has shrunk from 60 years to 50 years. Earlier, you used to always have completely gray hair, older people putting money in there. And now, almost a 10-year reduction in an average from 60 to 50 means the more younger people are coming to the markets and more younger people, NRIs or 30s and 40s, people are becoming more wealthy out there. And therefore, there's a big switch. The earlier the 60-year-old was risk covers and therefore came to equities much less. Later, the 40-year is ready to take all the risk in the market and doing that. The 60-year-old took time, but then trusted the professional manager. The 40-year-old today wants to do all things on his own. The 60-year-old investor used to relatively not have so much information as what is available today. And he left it to professional manager longer. Because I know for investor in a pedal who's been with us for 23 years. Yeah. But he's a really old guy, left his money with Bharat and doing that. But the 40-year-old has access to all kinds of information and knowledge about it. And he doesn't have patience. And especially in the last 3 years, post-COVID, he has made more returns than the fund manager or ourselves as well. So he believes that he can do much better. And I think our role in terms of becomes very critical here is to try and educate the investor, because communicating and building expectations at the start of starting a PMS or AIF journey is extremely critical out there. We at ASK Investment Managers have never created or sold portfolios only on performance out there. I think one quick data point I would like to share for most, because that helps in terms of for everyone to set the right example. When you look at one of the quotes which Desmond Tutu said, what we learn from history is that we don't learn from history. And what is the history of Sensex suggest is that the 44 years of the Sensex says that if you come to equity markets for 1 year, there are 32% of the time, or I think 14 or 15 times, you'll have negative returns in 1 year period of time. There'll be 17-18% of the time, if you come to the market, even for a 3 year, you'll get negative returns in the market out there. Around 8 to 10% of the time, you'll get returns in negative in 5 to 7 year period of time as well. And only once in 3% or 1 out of 30, that 10-year journey, which is from Harshad Mehta peak to down, there's been negative returns out there. But if you had stayed fully invested, it'll be baffling number. A crore becomes 731 crores as on yesterday evening in Sensex at a nominal compounding of 16.17. So I think what we at ASK try to do, while our oldest PMS in the country, ASK portfolio delivered 19% CAGR, we prepare the client and educate the client to come in with closer to 15% returns. And that's the most important point. And then obviously engagement, people, philosophy, commentary all goes in there. Yeah. But I think setting the right example, long-term returns of an asset class continue to be the same in the future as well, is what I would like to stop there.
Perfect. Yeah, Ananya. Ananya, you're on mute. Yeah.
I realized it. I just want to make one point, which is keep your feet on the ground.
Agree.
Hands in a pocket and maturity over the shoulders. You can't go wrong. I think this is a beautiful asset class where you can make a lot.
Yeah, that sums up all. In fact, I was just about to pass my concluding remarks, but I'm sure you made it so nice in 3-4 words. But personally, thanks a lot, Ananya and Nimesh. It was great interaction. And for me personally, I would say I've benefited a lot today. And maybe 1 or 2 things, if I just have to summarize and say what I taken away from this discussion. So Ananya, this is for you. What I have specifically taken away. I got to learn today that there are so many benchmarks, right? So I will always ask myself and to my investors, what's your benchmark? So at least today I learned there are at least 4 to 5 benchmarks. So the one benchmark is the manager's benchmark, which he or she have to break the indexes and all that. Another benchmark is the investor's benchmark, which is on a lighter side, which is the next best manager's returns. And super investors, so khair baat hi alag hai कि भैया best asset class returns मेरा benchmark है. But yeah, advisor's benchmark is the best one, which I realized today that one should focus on. And that is the return of the benchmark, which will help you meet your goals. Nimesh, thanks for sharing your personal story. I think what I could resonate with a couple of things there was risk is more of a state of mind, and return should always be evaluated in context of risk taken. And I think one thing which you touched upon very nicely was that the evolution of risk also happens over a period of time once you gain more and more experience and confidence over a period of time. And of course, that differs from person to person. So the long story short here is that one have to be patient enough to get those experiences and evaluate his or her own journey over a period of time. So this is from my side, ladies and gentlemen, and really appreciate for the time everybody has spent on this session. Over to you, Aishwarya.